Oh, baby, we got another one to talk about here, folks, and it's going to be one that is absolutely taken off to the moon here in the after hours. We're talking about Netflix up over 12.5% after hours, right? We're talking about $40 a share. Not insignificant, right? Um, Holy smokes, what the heck happened? Well, they reported earnings. We'll get into those earnings and try to put that boost in price there in context here a little bit. Kind of see why they did that and what's going on. So let's let's go ahead and take a peek. First thing I do, like we said, we always put the move in context first. We want to see how has this stock performed lately, because sometimes that can tell the story of why you see a jump up in price necessarily too. It's worth looking at. Now, year to date, the stock's actually had a pretty decent year, right? 17% up. We look 1 year out, about 27% up, not too bad. Um, but then we get 5 years out, and it tells a different story, right? Pretty lame. Hasn't recovered at all from their high they reached in 2021 when tech was really at an all-time high. Um, then the stock fell over 70%. And it's recovered slightly since then. I mean, we're talking about a 73% increase since then, but in the meantime, it's still not reached that point that it was at. When we're talking over $700 a share nearly, um, it's not there, and it's actually been on a decent downtrend here as of late, down about 20% in really just the last since last quarter, I guess is the best way to put it. And there was a lot of concern coming out of last quarter when we talked about the paid. Um, the paid sharing program, potential of losing, uh, losing memberships, things of that nature. So that's really what brought this down as of late. So, um, just by looking off the price, you can tell pretty well it probably was a pretty good quarter. But let's get into these earnings. Um, and we'll finish up with a shareholder letter after we take a look at these two. You look at the headline and nothing too crazy here. We see a gap EPS of $3.73, beats by 23 cents. Pretty significant, right? I mean, it is a lot of gap EPS, a lot of gap net income there to be considered. We'll find out what the exact number tallies to, but it is good to see an increase there, and especially a beat. Um, Quite significant because this is a company that struggled quite a bit in terms of profitability, and I think that looks pretty good for them. Now, from a revenue perspective, nothing incredibly exciting. We're talking about a 7% year-over-year increase. It was in line, 8.54 billion. Nothing crazy. But here's the line that people really look at and kind of why this one has done so well. Sorry, let me center that a little better so you get the headline there. Um, Global streaming paid memberships. This is the line you look at when you look at Netflix earnings. It doesn't matter much what they do. What matters is this line. 8.76 million increase to 24 or 247.15. Now last quarter was stinky. It was not good. That's pretty darn good, right? That's a great addition, and I think that goes to show um, that people are abiding by that paid membership program and that add-on user program more than people thought. A lot of people thought people would just flock from the program, find workarounds, but clearly it's working out for them here. Um, that's a big ad and more ads than they've had in really a hot minute. Now, from a guidance perspective, we look at Q4. Actually, a great guidance here: 8.69 billion expected of revenue versus 8.54 consensus, which is kind of right where they're at. They're expected to be pretty flat, and you know what that means? That means they're expected to increase subscribers again. And original consensus was kind of to stay flat, not increase subscribers. So great to see that. Um, EPS of 215 versus 220, obviously significantly less than this quarter, and I don't know. We'll see what that includes there, or if this one was slightly highly benefited from something. We'll see there in the shareholder letter. Let me. Oh yeah. Oh, the neck crack was incredible. Oh. Anyways. Um, That's not really relevant. So let's look on to a little bit further details here. Love Seeking Alpha, they always include a second article, goes a little more in detail. Then we're going to get the shareholder letter, which has the most detail. So, um, Top financial expectations, yeah. Best subscriber growth in years, as I mentioned, pretty nice. And confirmed it's going to raise prices. So they're going to raise prices, which increases that revenue even without them increasing subscribers. Um, so consensus was 6.2 million ads. That's what's worth mentioning. And they obviously topped that by 2.5 million, which is significant. So way over their expectation of membership there. Year-over-year growth rate of 10.8, which is, obviously very strong there. Better than they've seen in a hot minute, actually. Definitely better than they've seen in a hot minute. So, let's see. Better than expected subscriber growth due to the, again, as we mentioned, the rollout of the paid sharing, strong, steady programming, and ongoing expansion of streaming globally. So that's something they'll always flaunt is their content. They've got a lot of originals. They spend a lot on them too, so it is impressive to see really that EPS line stay where it's at. Pretty impressive if you ask me. So now they're expecting a free cash flow of roughly $6.5 billion, up from the prior forecast of $5 billion. Obviously, this is because this quarter smashed so significantly, and that's really nice. And you also see they've repurchased 2.5 billion shares in the quarter and increased the buyback by $10 billion, right? That's massive, right? That's really massive. And you want to know why? Well, a company's not buying back stock when it's what they believe is at all-time highs, right? That wouldn't be a smart decision for them to buy back stock at those levels. They believe the stock's going to be going up, and turns out they made a decent decision, and now they're buying back more shares. They're probably going to wait a little bit for hopefully a little simmer on the price after a 12% jump. But that's a great sign for shareholders. I think it really is. They're committed to it. The management's committed to it. They feel good about the price action. So very nice for them. It is moving forward with the price increase. So ad plans at $6.99, which is what they're at. The standard plan though is going to be $15.49 per month. That's just, I don't know. It's a stupid pricing point. I don't understand. I don't understand that piece of it. I think it's stupid to have something 49 cents. I don't know. Just kind of dumb. So ad plan price is still much less than the average price of a single movie ticket. I don't know why they need to say that. And there's ads to the movie, but there's really not in the middle of the movie. So I don't know what they're getting at there. I mean, there's not ads in the middle of the movie. So, but there's ads in the whatever. Let's take a look at the shareholder letter after kind of a stupid note that they added there. So they don't necessarily have slides, which are that fun, but they do have the shareholder letter, which I do like. And we'll talk about that. So let's go into these bad boys as well. They do have a whole page for this too. Ad plan adoption is strong, which is kind of where we see a lot of these growth. So ad plan membership up 70% quarter over quarter, which is pretty significant. Slight cough there, don't you worry. Here's a nice chart here where you can kind of see this as well as forecasted growth here. And this is obviously where we see a lot of negativity from last quarter. It's just that the numbers weren't incredible. And then, here they come this quarter and say, hold my beers. That's what they're saying. Net income did equate to 1.6 billion, which, I mean, that's really significant when you talk about an $8.5 billion revenue line. I mean, that's a massive, massive line there. 22% operating margin, right? That's really good, and really good to see. Now Q4, I mean, they just usually take a hit in Q4, but they're still expected 13.3% operating margin here next quarter. I'm trying to think like Q4. I presume something to do with paying of contracts or something of actors, maybe. I don't know. But Q4 seems to be they take a big hit there in terms of EPS. I don't know. But then we look at global streaming paid memberships. Obviously good there. 10.8% growth. So pretty significant there. More than they've had in a long while, as you can see. So, yeah, free cash flow looking good there too. Here's a lot of text. Does anyone care about the text? I don't know if you do, but let's get into more charts, okay? Here's engagement. The Nielsen's, they got a Nielsen's chart in here showing that streaming is just, dominating screen time here. 37.5% of US TV screen time is streaming now. It is shocking to me that 29.8 of that is cable still. Still shocking. And broadcast 23. This, I don't know. Weird to see, but you can see who's leading the way. It's going to be YouTube, not only through YouTube itself, but YouTube TV. Netflix number 2, and then you get kind of further down, and you've got your Prime Video, Hulu, and a lot of that benefits because of Hulu Live. Hulu Live TV definitely kind of cuts down at the cable a little bit. And then your lower ones here, your Disney Plus, and I don't know who the heck watches Peacock, Paramount, and Pluto. It's just kind of lame. They just kind of stink. The platforms aren't great. So kind of move past that. They just kind of talk about the content they've created, which isn't super exciting. I like moving on to the charts because we love looking at charts, right? Operating margin, oh yeah, it's a good thing to see, right? We look back here and struggle. Free cash flow negative all the way until 2020, was negative in 2021, but now we're seeing that positive growth, and I think it's a great sign for them. That free cash flow is actually busting out into the positive. It's busting. Oh yeah. This one I like too. Regional breakdown is a chart I like to look at. You can kind of see where they're at. So U.S., Canada, as you see here, making up around 3.7 of the revenue, pretty significant. And then we're gonna get into Europe, Middle East, and Asia, or in Africa, I should say, and that's going to include 2.6 billion of the revenue. Then we get Latin America, 1.1, and then Asia Pacific, which they haven't really scratched the surface there too much. Only 42 million subscribers there, and much cheaper plans you can see here too. The average price per membership only at $7.62, pretty cheap. And then you look here, which is kind of annoying. Look at the U.S. Look what they're screwing us, dude. They're screwing us. What the F's that about? But you do see a decline in Asia Pacific, so definitely a segment they're going to want to, probably target a little more. There's a lot of individuals when you look at Asia Pacific too. So, last thing I wanted to point out is, what's coming up. It's the balance sheet, baby. I'm about to pull up that balance sheet. 49 billion. 49 billion in total assets compares to 6 months. Oh, they're giving me a 9-month comparison. That make me pretty happy. 48.5, so $1 billion increase there. Really just came from total current assets, just an increase in cash and cash equivalents. They're a little bit heavier on cash. Now, liabilities actually declined. That means the shareholder equity has increased over the last year. Pretty nice. So we're talking about $22 billion, which is pretty significant, right? About twice as much in terms of assets as you have in terms of liabilities. That's a ratio that I like quite a bit. Yeah, I mean, I like that. I like the ratio here. I do. So yeah, we're looking good there. Let's just take a look back at the stock again and kind of see what we're looking at, right? We're talking about a 4 PE ratio, which is kind of hard to expect here, of Netflix actually just crept today under 30, right? Which the stock's never seen valuation like that. It never has. Now, obviously, after a 13% movement, you're not necessarily going to be seeing the same cheap valuation, right? And a market cap was at 153. Now, obviously, going to be boosted here to about one. I'd say you'd be looking roughly at one. Sorry, that was gross. I belched. Over 170 billion for the market cap. Off of an annualized revenue. From that perspective, I'd say it's probably around 35 billion in annualized revenue. So not an incredibly expensive stock necessarily, but it's not one that's necessarily showing massive growth either, right? Single digit growth rates. Is it worth trading at a multiple higher than they are right now? And we talk about still a price to sales. Um, if we're looking at that market cap, um, we're talking about, based off of the revenue, about, what did I say, it was about 170 after this, so, and about 35 billion. So, I mean, five times that. It's not incredibly expensive for most tech stocks, but again, it's just, I think the avenues for growth are definitely limited for them. That's kind of one of the disadvantages of the streaming industry is, the only way they increase revenue is by increasing subscribers. At some point, you kind of reach a cap there, and you don't necessarily increase as much, or increasing price is kind of where they're at right now, is increasing price. So it's definitely a disadvantage that they have because they can't necessarily keep up significant growth rates, and that hurts the multiple, right? It's hard to trade at a high multiple when you do that. Now, even after 13% gain, I don't, I don't love the levels it's at. Again, and I only say that because it's pretty heavily volatile. There's no doubt, but I just don't like the fact that, I can't see it bumping up to a massive multiple again, just because the stock's really leveled out in terms of revenue growth and everything of that nature. It's going to reach a point here in the next few years where it just, they the subscribers are going to stay relatively flat. When they're growing subscribers by a lot less, it's just the revenue is not going to budge much, and I just don't know if I see the stock moving up whenever that revenue declines more, or I guess the growth rate declines. So that's what I got for you here, folks. I hope you had a great one, though. Bye.